Most investors think ETFs and index funds are different, but you're often investing in the exact same thing, just in a different wrapper. And not understanding that can cost you money. Hi, I'm Kelly. I've spent over a decade working in corporate finance, analyzing investments, and making real financial decisions. I've built my portfolio privately, and now I'm building it publicly in real time using my own money and documenting every step as I invest towards $1 million. Over the years, I've seen how confusing investing can be for others. You feel stuck, overwhelmed, and second-guessed every decision. But most of the time, you're not doing it wrong. You just haven't been shown how to think through ETFs and index funds in a simple way. So today I'm going to break down what most beginners get wrong, the real difference between ETFs and index funds, and what I'm personally investing in and why. So if you're serious about building wealth and want to stop wasting time on random finance videos, subscribe. Now let's start with index funds. Index funds are a type of mutual fund. And here's why that matters for you. This is one of the easiest ways to start investing without having to pick individual stocks. Index funds are diversified, low cost, and passively managed. So if you've ever looked at the stock market and thought, what am I supposed to buy? This removes that pressure completely. If you invest in an S&P 500 index fund, you're investing in companies like this. Think about that for a second. Instead of trying to guess which one of those companies will win, you own a small percentage of all of them. So if one struggles, another one can grow. That's how diversification protects you. And here's why beginners like index funds. First, they're easy to manage, and you aren't paying a portfolio manager to try to beat the market. Second, they're great for long-term investors because over time, the market tends to rise as businesses grow and profits increase. Third, they're low risk because there's so many companies in one index. If one drops, others can offset it. Fourth is diversification. Fifth is a low expense ratio. You're paying very little in fees. Sixth is index funds are tax efficient because fewer trades mean fewer capital gains. For example, Vanguard's VTSAX requires $2,500 to invest. However, Fidelity has some with no minimum, but it depends where you invest. You also can't outperform the market because you are the market. And there's less flexibility because you're buying the entire group of companies, whether you like every company or not. So let's say you finally decide to invest in an index fund, but then you see an ETF as an option. And this is where things start to get confusing. ETFs, or exchange traded funds, are often described as a box of securities. So when you buy one share, you're buying a bundle of investments, which can include stocks, bonds, or other assets. Think of it like this. An index fund is what's inside the box, and an ETF is the type of the box. ETFs are a happy medium between stocks and mutual funds. I discuss mutual funds in more detail in another video, which you can watch after this video, and I'll link that below. ETFs are similar to trading stocks because they can be traded during the day, essentially when the market is open. An ETF is similar to a mutual fund because they're diversified between a collection of stocks or bonds that are professionally managed. Now let's compare between ETFs, index funds, mutual funds, and stocks. As seen here, ETFs are diversified, they have low costs, they're passively managed, they're flexible, and tax efficient because they rarely distribute capital gains. Stocks in this case are passively managed only if you want them to be. You can choose to have a portfolio manager to manage your stock picks. And the key for mutual funds is they have higher costs because they're actively managed. The real difference between ETFs and index funds is how you invest in them. ETFs trade like stocks. You can only buy them when the market is open, and you have control over the price. I will show you how to do this later in the video. Index funds are different. You can place an order anytime, but the purchase doesn't actually go through until the end of the day at one set price, meaning you don't know the price of the stock at the time of purchase. For example, let's say you place an order at 10 a.m. The market moves all day. At 4 p.m., the fund calculates its price or net asset value. Your order then executes at that price. The price could be higher than you expected or lower than you expected. And depending on how you invest, that flexibility can impact how efficiently your money grows over time. Now let me show you what I'm investing in. But first, I want to be transparent on where I received this week's earnings. I put all the receipts together, which include my credit card rewards, dividend, and interest income, along with my birthday money that family members give me every year, totaling $255.90. I'm showing this to you because you don't need a perfect plan to start. You just need to start. If you invest consistently over time, even small amounts can grow into something meaningful. And the earlier you start, the more time your money has to work for you. Now let's invest. Today I'm choosing VUG. VUG is a great example of both an ETF and index fund. Because it's an ETF, it also tracks an index, limiting the order to buy at $443.75. And the order was successful with 0.576 shares. And it looks like 30 cents was left in a money market account, which I can just use next time. I'm choosing this because it aligns with how I build portfolios focused on growth, diversification, and low cost. I also invested in it before. And here's an updated spreadsheet for income earned and everything I've invested so far. Now, here's something important most people don't realize. When you buy an ETF, you have two options: market order or limit order. Here's why this matters for you. This determines the price you actually pay. If you buy at market, you're prioritizing speed. But if you use limit order, you control the price you're willing to pay. This is where small decisions can cost you thousands over time. And one quick note, VUG is scheduled for a 6-to-1 stock split on April 17th, and the new price will be available to investors on April 21st. All this means is the price per share goes down and your number of shares go up. For example, if you have $2,100 and you want to invest in VUG at $420, that gives you 5 shares. After April 17th, you'll have 30 shares, but the stock will now be worth $70. $70 times $30 equals $2,100, but it doesn't change the value of your investment. Vanguard just makes shares feel more accessible. So, are you ready to invest today? Because every day you wait is a day your money isn't working for you. And if you want to grow your wealth and want to avoid the mistakes most beginners make, subscribe. I post one strategic lesson every week. And if you want a clear step-by-step plan tailored to your goals, you can work with me one-on-one. I'll link that below. See you next week.